$900 billion just vanished from the stock market in a single day. Oil just posted its biggest weekly surge since 1983. And at the same time, millions of ounces of physical silver are quietly leaving the COMEX fault system. Now, here's the part most people are missing. These events are not separate stories. They're all connected. Watch this carefully because every piece builds on the next. And one of these signals could be the one that matters most for your portfolio. And if you're following the breakdown, drop OG in the comments so I know you're paying attention. Let's get into it. Markets just closed for the weekend, and there's something important to understand. Major geopolitical developments often drop when markets are closed, when investors can't react and retail traders can't move. Right now, several developments are unfolding simultaneously. Reports suggest ground troop discussions are happening privately. The Strait of Hormuz is functionally closed to ships linked to the US or Israel. Iran has launched another wave of missiles, and the IRGC has openly challenged the US Navy to escort tankers through the region. That means when markets reopen Monday morning, they could be reacting to an entire weekend of developments all at once. Keep that in mind for everything else we're about to discuss. Let's start with oil, because this story is now impossible to ignore. WTI crude just posted its largest weekly gain since 1983, jumping 34.5% in a single week. On Friday alone, oil reached around $91.50, which puts it 66% higher than where it traded in December. To keep tankers moving through the Strait of Hormuz, the U.S. Treasury has announced a $20 billion insurance backstop program through the Development Finance Corporation. That program covers ships transporting oil, LNG, jet fuel, fertilizer. The key detail here is simple. If governments need to create a $20 billion insurance program just to move energy shipments, that tells you how serious the disruption is. Right now, roughly 20% of global oil supply is affected by the situation. Technically speaking, the next major level on WTI is around $95, which was the September 2023 high. We're only a few dollars away. If that level breaks with momentum and shipping disruptions continue, then $100 oil quickly becomes part of the conversation. There's another development here, getting very little attention. U.S. officials have floated the possibility of lifting sanctions on Russian crude oil. Think about that for a moment. In the middle of a geopolitical conflict, pushing oil toward $100, the idea of bringing Russian supply back into global markets is suddenly being discussed. That could mean one of two things. Either it's a pressure valve strategy to cap oil prices before they become politically unmanageable, or it could signal a much larger geopolitical realignment happening behind the scenes. Either way, it's something worth watching closely. At the same time, the U.S. defense sector has agreed to quadruple production of advanced weapon systems. Officials have stated that the U.S. has virtually unlimited supplies of mid-grade and upper-grade munitions available for deployment. That's not the language of de-escalation. That's the language of full wartime mobilization. When you combine expanded weapons production with an escalating bombing campaign, the range of outcomes for markets next week becomes dramatically wider. Another factor that could quickly escalate the situation is logistics. Right now, roughly 99% of ships are avoiding the Strait of Hormuz. The Middle East relies heavily on imported food, water, energy supplies. If shipping disruptions last more than a few days, the region could begin facing serious shortages. A regional food or water crisis layered on top of an oil shock, active military conflict, and global inflation pressures is a combination that rarely resolves quietly. Now let's talk about the economic impact. Historically, every $10 increase in oil prices adds roughly 0.2% to inflation. Oil has moved from the mid-$50 range to over $90. That means more than 1% of additional inflation pressure may already be building in the pipeline. At the same time, recent labor data has shown signs of stagflation risk. And this is where the Federal Reserve faces a serious problem. You cannot fix a supply shock caused by war with interest rate cuts. Which means policymakers are dealing with an inflation scenario that monetary policy cannot easily solve. Markets reacted immediately. On Friday alone, over $900 billion in equity value disappeared from U.S. markets. The S&P 500, NASDAQ, Dow Jones, and even European markets like the DAX all closed lower. Bitcoin also dropped below $68,000. But here's an even more interesting statistic. The first 41 trading days of 2026 produced the narrowest trading range in S&P 500 history, going all the way back to 1928. Even the Dow Jones has not seen compression this extreme since 1896. Historically, compressed markets behave like coiled springs. The longer volatility is suppressed, the more violent the eventual move tends to be. Now let's talk about silver, because beneath the headlines, the physical silver market is flashing signals most investors are missing. COMEX total silver inventory just dropped to around 349 million ounces. In a single day, another 2.2 million ounces left the vault system. Over the past 30 days, more than 51 million ounces have drained out. That's nearly a 13% decline in 1 month. Even more important is the registered inventory, the metal actually available to settle futures contracts. That number currently sits around 81 million ounces. Meanwhile, futures contracts represent roughly 7 times that amount. In other words, for every ounce of deliverable silver in those vaults, there are nearly 7 ounces of paper contracts. That imbalance resolves in only 2 ways. Either new metal flows back into the system, or prices rise sharply to ration demand. There isn't really a third option. Another factor entering the equation is China. U.S. intelligence reports suggest China could potentially supply Iran with financial support, spare parts, missile components. If that happens, the probability of a quick reopening of shipping lanes drops significantly. At the same time, China has already implemented export controls on certain silver-related materials. 2 separate trends, geopolitics and supply restrictions, are converging on the same physical metals market. As of the latest close, silver ended around $84.60 after rejecting the $85 level multiple times. Shanghai prices are roughly $12 higher, showing a significant regional premium. Gold closed near $570, with key technical levels around $5,180 and $5,200 still in play. The frustrating part for silver traders is that the dollar weakened, yet silver still couldn't break $85. That raises an important question for next week. If the dollar continues falling, silver should normally rise. If it doesn't, something else may be happening in the market structure. To stay balanced, we also need to acknowledge the downside risks. The COMEX leverage ratio means paper selling can still push prices lower in the short term, even if physical supply is tight. War headlines can also cause sudden algorithmic reactions in both directions. And following the recent 22% margin reduction on silver futures, it is now just as cheap to hold short positions as long ones. So short-term volatility remains extremely possible, but none of those factors change the longer-term structural picture in the physical market. When you connect all the dots, the key variable to watch is simple: oil. If the Strait of Hormuz remains disrupted into Monday, $100 oil becomes a realistic discussion. That feeds directly into inflation pressures the Federal Reserve cannot control. At the same time, global equities are showing stress, geopolitical tensions are escalating, and physical silver continues leaving exchange vaults. The next few trading sessions could be extremely important. So watch what happens between now and the Sunday night futures open. Because markets may not be walking into Monday, they might be running into it,